So is selling stocks a good idea? I've been pondering on this question because in theory, you buy something, you want to hold it forever, and then comes bad performances, comes doubt, should you hold, should you sell, should you buy more? And you cannot answer those questions if you do not have investment rules. So today we're going to look at the past where I sold 3 stocks years ago. We're going to see why I bought them in the first place, why I decided to sell them, and the investment rules that comes with it. So investment rule number 1, sell when the investment thesis doesn't equal the dividend triangle. So what does that mean in the first place? Well, you have your investment thesis on one part. So this is the story you tell yourself. This is the narrative why you like this company so much. And on the other side, you have financial metrics telling you if your story is actually a good one, because then you will have the revenue increasing, the earnings increasing, and of course, the dividend increasing. So way back, I bought McDonald's, ticker MCD. I really like that stock. And when you look at the dividend triangle back then, it was growing. So from 2010 to 2012, the revenue, the earnings, the dividend was like super strong. And then I bought it in 2012. I was super happy with my purchase. Everything was running fine. The dividend triangle was really solid. And I like the fact that this company was across the world selling burgers, recession resistant because they were offering like value meals and stuff like that. So everything seems well. And then started to slow down. The stock price went nowhere. The company had a lot of problems, like margins were under pressure. Sales in China was slowing down. And then they tried a bunch of different stuff, such as, I don't know if you remember, but they tried to have at your table service, gourmet burgers, all of those things. And during that period, I was like, yeah, that's not really working. The revenue started to stagnate a little bit in 2014, and then the earnings started to go down. And then I sold. I sold because I still believe in the company, but the metrics were not as strong as expected. But here's the thing. I didn't wait a long time. And when you look at what happened after that, well, selling McDonald's was one of my deepest regrets in terms of like selling a stock too fast. Because after that, yes, you can see that the revenue kept on declining until 2020, but that was because they were changing their business model. So as the company was selling franchise instead of owning and operating them on the corporate side, they saw, of course, the revenue going down. However, you can also see that on the other side, the earnings was going up. The other thing that they did is they continued to work on their menu and brought breakfast all day, which was a game changer for them. And since then, they started to be a lot more flexible with the franchisees. And on top of that, getting more traction with a better menu and opening new location. So what I realized here is I should have waited 2 or 3 years before selling. And now what I do is I still keep that rule where that my investment thesis must equal the financial metrics. But on top of that, if whenever it doesn't happen, I will set a time limit. So 2, 3 years, depending on the stock, depending on the situation. But I'm not moving from 2 to 3 years. I just say, okay, I'm going to wait 2 years. I'm going to wait 2 years and a half. I'm going to wait 3 years. And then I'm going to highlight the items I want to monitor quarterly. So I want to hear back from management about those. I want to make sure that they are applying a plan, that they have a plan in the first place, actually, and that we see sequential improvement. And then I'll decide if I keep the stock or not. For the fun story, I actually sold McDonald's and bought Black Diamond Group, BDI.TO, which eventually cut their dividend about 2 years later. So I sold a potential winner to buy a loser. That was definitely not a good trade. Moving on to now rule number 2, financial metrics speak louder than the narrative. So following up on my story, now we're going to move on to a different one with Algonquin Power. So what I want to show you here is for several years, the company was thriving. So Algonquin was all about acquiring utility assets and then rebranding them, like retransferring them actually into green power, like generating like renewable energy. They acquired a lot of clients It was going well. They were using cheap debt to fuel their growth. And as you can see, until 2022, everything was going well. Well, it's not exactly right. While revenue was going up and the dividend was going up, I should have known better, because since 2021, the earnings per share were declining. Now, I already told you in the last video that you cannot just look at earnings for capital intensive companies, because when they make a lot of acquisition, you see that the amortization is going to wait on the balance sheet, but really it doesn't affect the company's ability to pay the dividend. What I should have used, though, when I look at the earnings per share declining, that is still a red flag. I should have looked into the funds from operation, look into the business a little bit more, and then realize that a big chunk of their debt was on variable rate, and then that interest rate charges were ramping up quickly. Super bad management. In middle of 2022, they still increased their dividends. So I was blinded by my story, telling myself, well, it's normal. They grow by acquisition. It's all good. And on top of that, management just increased their dividend. So I should trust my thesis. Like, the story is really strong and it's going to continue this way. Well, unfortunately, that led, and that you know the story, to a dividend cut at the beginning of 2023. And then it was just downhill from there. So what I've learned here is to focus a lot more on the financial metrics and not just my story. And if the financial metrics are not there, it's time to move on. Fortunately for me, I applied rule number 3, which is sell when there's a dividend cut. Now let's take a look at the dividend triangle for Algonquin after the dividend cut. So on the day they announced that dividend cut in January of 2023, I sold my shares and I never looked back. The stock price jumped back a little bit and then eventually go down and down and down. The revenue fell, the earnings per share continued to fall. And for a lot of investors that keep their companies, their stock after a dividend cut, in the hope that this company will recover, that will rebound, I would just tell that. Ask yourself what a company must do to recover, to rebound. And in this case for Algonquin, well, they were great when they were borrowing cheap debt to acquire assets, which is impossible in the current situation. Even worse than that, their plan to restructure the business, which is fine, but it's not going towards growth, was to sell assets and reduce debt. So they were once popular and successful because they grew by acquisition using leverage. Now they're going to deleverage, reduce their assets, and try to become a regular play in the utility business. Well, it's great, but it's not going to bring the company up double digit in terms of growth, right? And this is why it was the right time to sell. And the lesson here is really to focus more on the financial metrics, less on the narrative. And I paid the big price for this one. Rule number 4 is investment thesis must remain valid. What does it mean by that is the reason why you buy a stock in the first place should continue to be valid throughout time. If it's not valid, it's probably the time to move on and sell. That doesn't mean that the stock price would go down or would go up. It just means that if it's not aligned with your strategy, it's not aligned with your conviction, then you sell and you move on. So here's a good example. Enbridge. I bought Enbridge in 2017 when I got my pension plan. And I bought it for 2 reasons. The first one, there was some price weakness. As you can see, the stock price was stagnating, slightly going down. There was a lot of problems with regulators, but all of this was business as usual for Enbridge. So I kind of like the fact that there was a price weakness. And on top of that, the company was thriving on many other points. They had this ability to increase their dividend double digit. It was like a 10% increase every year. They had long-term contract, very stable business. So when you find a mix where you have a stable business model with predictable cash flow and 10% dividend growth rate, that's kind of crazy, right? You jump on that opportunity. And this is what I did at the end of 2017, and I ended up with a smile. Fast forward to early 2023, the company generated a good profit in my portfolio. So counting the dividend, I think I was up like 50% or something like that. So 50% profit, very solid, very happy about that. The stock price was like hovering about the same thing, but I didn't mind because I don't focus on the stock price fluctuation to determine if I should buy, sell, or hold. I focus on the investment thesis and the financial metrics. But in this case, the investment thesis was not there anymore. So the company kind of slowed down a little bit. I mean, it's capital intensive. It has a lot of debt, keeps on racking up more debt, and interest charges keeps on going up with higher interest rates. So already I didn't like that. But on top of this, we went from a 10% dividend growth rate to a 3% increase. 1 year, 2 years, and then on the third year was like, all right, so I bought this company for high single digit, double digit dividend growth potential. Now we're down to 3. It becomes a bond proxy type of investment, and it's nothing against those type of investment, but it's not aligned with my strategy. So for that reason, I decided to sell my shares at the beginning of 23 because I didn't like what I see coming. And on top of that, Enbridge was not a low yield, high growth stock anymore. It was a bond proxy or deluxe bond. So a stable business paying a high yield, but offering a small dividend increases. And this is not what I want right now in my portfolio. And this is why I decided to sell. So not saying that it was a bad business, it was just not the right business for me, which is a big difference between both, right? So what I did instead is I sold Enbridge and bought CCL Industries. I did videos on that, podcasts on that, so you can research that on the channel. But CCL Industries has a better profile linked to my strategy. Low yield, high dividend growth potential, and lots of growth overall with good diversification international business. So I really liked it. So fast forward today, did I make the right decision? Well, for 2 years, it's not that long to compare. For a long while, I was a winner. And then as of late, since the beginning of January, mostly Enbridge has kept on going up and now shows a total return of like 53%, while I'm showing a total return of like roughly 29%. So 50 versus 30, definitely I should have kept Enbridge, but that's not the lesson here. The lesson is it's important to be aligned with your convictions. If you're not aligned with your convictions, if you're not following your strategy, you're going to have doubt. I mean, the opposite scenario could have been there, and then I would say, hey, look at me, I'm a genius. Enbridge is down 15% and I'm up 30%. But that's not the point. The point is that you cannot be right 100% of the time. You're going to make mistakes. And then sometimes you're going to sell potential winners in the future. Sometimes you're going to hold on to your losers for too long. So it's impossible to know. But what you can do, what you can control, and get rid of the analysis by paralysis. So start moving forward and modify your portfolio according to investment rules. So what I did here is I took away the dilemmas in my portfolios and I focused on clear and simple rules to follow. That enabled me to have a higher conviction in my portfolio, and I sleep better at night. And that's the whole point, right? We all invest to make money and sleep well at night so we can retire and enjoy our retirement. And this is the way that I can do it, by clean and straightforward investment rules. So, all right, guys, that's enough for today. Do not forget to subscribe to the channel, give me a thumbs up, and until the next video, don't forget to stay invested.